So should investors view the market uncertainty as a buy-the-dip moment or a warning sign? Let's bring in Neuberger Berman Group President and Chief Investment Officer Joe Amato. Joe, good to see you.
Hey, Mike, good to see you.
I mean, it could be both at once, I guess, depending on your tactical orientation, your time horizon. Has the market sort of repriced to a point where the direction of surprise is positive in terms of resolution, or are we already baking that in?
Well, we've had a decent bounce, right?
Yeah.
You know, we had a 5% or so bounce last week. We're now only down less than 5% from the beginning of this, conflict. That said, if you go underneath the surface, 40 to 50% of the stocks are 20% below their one-year high.
Yeah.
So you've had a lot of carnage below the surface, even though the indices broadly are not much lower, and reflecting the fact that I think people do think a resolution of this is coming sooner rather than later.
It does feel that way, and I think I always like to play the game of what year is it? Some people say, well, it's like 2025. We had this first quarter, early April gut check. It was severe. We thought it really was a game changer with the tariff panic. And then you had almost a V bottom once you de-escalated out of that and the economy was fine. You had 2022 where you had an oil spike, and that was kind of just the beginning, and the Fed had to get, a little bit tighter than expected. So, I mean, not that it's either or, but how are you leaning?
Well, I think each of these years have had idiosyncratic issues, right? In 25, you had actually an almost 20% drawdown, right?
That's for sure,
post-tariff. So it was a much more significant decline. In 22, you had a combination of an oil spike, but rate rises, inflation picking up. So, each year, each of these situations are unique in and of itself. But, when we began the year, we were optimistic about nominal and real growth, looking both globally and in the U.S., right? So I think we're going to get back to that discussion, right, in the context of the underlying fundamentals, which remain, I think, from a trend line, reasonably positive, despite all the bad news that we're dealing with and the challenging issues that we're in the midst of, which is sort of like the fog of war right now.
I guess one of the questions is whenever, we sort of emerge from this phase of uncertainty about the conflict is, are we going to resume the patterns of before? In other words, it was non-U.S. equities over U.S. It was a broader market. It was value over growth. Or has this period been something that scrambled that relationship?
Well, I think if you go back to an environment where the expectation is for higher nominal growth, I think that broadening out theme, which was one of our themes as we entered the year, I think that broadening out theme is going to be quite relevant again, because in a higher nominal growth environment, economies that are more cyclical, so you think outside the U.S., whether it's Japan, China, others, stand to benefit more from that. Small, mid-cap, which tend to be more cyclical, right? So that broadening out theme is important. Now, we've seen a revaluation of some of the U.S. large cap and some of the Mag 7 stocks, so they start to get a little more interesting when they're trading at more rational valuations.
I mean, I guess the conventional wisdom, which is correct, is that if oil stays up here, that seems to bite more in non-U.S. growth, at least many economies outside the U.S., and they had been some of the stronger ones, right? Like some of the Asian economies based on the memory chip trade and other things. So how does that weave through the outlook?
I think it comes back to the duration of this conflict and to what extent oil prices remain at higher levels. And demand destruction, I think, can come in two forms. One is a extended period of higher oil prices. So then consumers, whether they be here or outside the U.S., think differently about what they're spending money on, and that could slow the economy down. The second is just pure shortage. Right? If you don't have jet fuel, aircraft are not flying, right? So even if prices don't stay at a much higher level, so we do have to monitor both of those dimensions of what demand destruction could be. But certainly the economies, to your point, outside the U.S. are a bit more vulnerable. They're more cyclical. They're more dependent on imported oil.
What's your read on how investors, how clients have navigated this? Because there was so much talk early part of the year as the individual investor is just resolute and buying every dip, and the risk appetites remain high, and it's a different type of investor today. I'm seeing some outflows. You're seeing some people wonder if this is a game-changing event. So how has that been manifest in your book?
We serve a wide range of clients, primarily institutional. And I think they're taking more of a wait and see. And the advice we've given them is stick to your strategic allocation that you began the year with and use these pullbacks as opportunities to reinforce those allocations that you are looking at for that more 2 to 4 year, 1 to 3 year time horizon, which they're focused on.